Let me just remind you, if you would like to win a copy of the Edge Finder, we mentioned it earlier, but new people have probably rotated in. We're going to be dropping a link to the free entry giveaway for a chance to win a copy of the Edge Finder. We're going to give away one in the next week. Let me also just mention, I'm not sure if we did this already or not, but if you're watching on Twitter, maybe James, if we could make sure we've dropped a comment for this, because I don't think it's in the default text that we send out. But if you're on Twitter, I know we've got a bunch of people watching on Twitter and on YouTube now. We've got currently, let's check this out. Okay, cool. It's already over there. Awesome. James is on the ball with that. We've got 255 people on YouTube. We've got 167 people on Twitter. Very cool. Okay. Real quick, guys, we're going to just take this break. We're going to set up the stream for Chris to be joining in the call. We'll talk to him about what's going on this week and whether or not these markets will keep pushing higher. Let's get into it. Real quick, I wanted to throw a shout out to our stream sponsor here on the A1 Trading Show, Forex VPS. If you haven't heard of Forex VPS before, they are a dedicated hosting platform where traders, especially algorithmic traders, can set up an in-the-cloud computer to run their MT4 24/7. If you have any experience trading with robots on MetaTrader 4 using expert advisors, they have to remain up all the time, and keeping your computer on is not always practical if you have like a power outage or that sort of thing. And with Forex VPS, you can set up a dedicated hosted computer in the cloud to host your MT4 or 5 platform. They have the fastest execution in the industry with latency less than 1 millisecond, which means when you place trades or your system places trades, it's near instant. So I've got my VPS open here from Forex VPS, and you can see, I just want to show how quick the latency is here. So if I click sell, you can see it is right away. I'm in the trade, all set, as if I was sitting on this computer, even though it's somewhere in the cloud. For stream viewers right now, Forex VPS is offering 30% off of your final subscription. If you're interested in giving it a shot, there's no risk. Why not? Use the link down below and the promo code there, A1Trading30, for 30% off. If you're watching this stream at a later time, you can also find it linked in the description below. All right, and we are back with Chris Pulver. Hey, Chris, how's it going, man?
What's up, Nick? Nice haircut, man. Looking good.
Thank you. It's a little shorter. It was getting long. I went on a guy's trip up to Tennessee, and I had to wear a hat because my hair was like falling on my face. I was like, you know what? It's time. It's time.
It's time.
Yeah. Anyways, Chris, this week has been crazy, man. We've had every bear case has been hit with a baseball bat for the S&P and the NASDAQ. I mean, I have to admit it. I thought we would not get a V up reversal, and we got a perfect V here, and now V plus some, because now we've broken through the highs. Walk us through, why is the market so bullish here? And is this just going to keep going? I mean, we're at 5,300 on the S&P.
Yeah. So a couple of things, just talking about the indexes. So a lot of my trading the last couple of weeks were sitting right here. Mm-hmm. And I put on positions where, we had PPI data this week. We had CPI data this week. There's enough juice from the Mag 7, enough consensus that was positive on earnings, and enough kind of quiet talk post FOMC that I thought we could at least test the all-time highs unless the inflation data came in really, really nasty, and then we'd fill the Apple gap. So I was directionally neutral going into this play, but planning on volatility, and we got it. So I did take some nice profit this week on reaching the previous highs. I was very protective of those profits, probably earlier than I needed to be, but allowed me to take profit, redeploy, take profit again. And I did that on the SPY, the DIA, and the QQQ. Now, why are we showing all-time highs? Well, it's because of everything we just talked about. It's because inflation is getting better. This is your headline inflation versus your core, and notice the downtrend, right? So, I mean, the Fed is slowly but surely getting their kind of Goldilocks scenario of softening labor market. The consumer's cutting back on retail sales, and consumers cutting back on spending a little bit, and inflation is in fact going down. At the same time, stock optimism is happening because right now we haven't explicitly said that we're going to cut, but obviously the market is anticipating a September-December rate cut this year. So it's like the higher for longer, the light at the end of the tunnel is visible. The markets are running with this. The market's always typically forward thinking 6 to 8 months. And we have right now the runway where Nick, I'm pretty bullish going into like July and August. I do wonder what September to December looks like. Now, historically, yes, Q4 is usually really bullish, and even post-election, I would imagine that's going to still try to finish on a high note. Yep. But I wonder now this, and I said this on Monday. I was with you guys on Monday. I mean, my biggest concern moving forward is we're sitting here at all-time highs, and we have momentum disagreeing and all-time highs with overbought conditions and relative strength disagreeing. That's on the Qs, that's on the DIA, that's on the SPY, that's on everything for the major indexes. Now, that to me doesn't mean that we have a bear market, but there's a couple ways I see this playing out. I could see the markets being a little bit trickier with let's say another pullback here, and then another rally, and then another pullback and a rally. But the one thing we have been noticing is very low volatility. The VIX is down again, like 1250 or lower. What's the VIX at today? I think it's down again.
It's down.
It is sitting at 1236. I mean, yeah. So, I mean, and the IB ranks on the indexes are single digits. The VIX is really, really low. I don't think it's going to stay like that, but this doesn't mean we have to have some crazy dramatic event. It just means I think the market's going to at least shed a little bit of this all-time high, see if we can buy the dip and justify this. But what I'm looking at is I'm trying to put my crystal ball cap on here for a second. How far out could I go to not break any structure? If we, have a dip, have a rally, have a dip, have a rally, and this starts to form what I think could be a rising wedge, there's two ways I see this rising wedge playing out. A typical rising wedge is we break the structure and we fall back down into where we started, okay? But the other side of this rising wedge is the market breaks out and we have a capitulation move. And right now, I'm almost thinking as we have this runway, we have this Goldilocks scenario, the market seems to be pretty optimistic and excited about everything right now, that we might just continue to push higher, man. And this might be a market where it's like, what a crazy run that was, what a crazy recovery that was, and then reality's later. 2025,
Yeah.
Just thinking.
Yeah. I mean, it really could. And that's the thing is, Chris, I'll give you my take on it too, is the overall picture of the economy starting to slow. I've made this point many times of, the Fed has not a great track record of getting it wrong, or getting it right. But markets can go parabolic a lot longer than the full story takes to play out. Or a lot longer than people think before the full story plays out. And so I am very much thinking that, we may continue to see, as you mentioned, some seasonality looks really good here. You're talking about coming into May, June, July, August, all 4 of those months. There's a nice little seasonality play here that you could take advantage of if you are bullish. I'm not saying you go out and you buy as soon as it hits the highs, but I'm saying, if you see pullbacks on some of these names, I mean, I'm exposed long. I did something similar to you, Chris. You mentioned maybe capping your upside a little bit too soon. I think I heard you say it that way. I definitely did that. I sold calls against my VOO position at 480. So I missed the CPI move on my S&P. So not great. That expires today. I'm considering rolling it. That's big fancy moves for me because I don't know all that about much about options, but I didn't think we'd get the V up. So I was wrong, but still made money. That's why I love options for that reason.
Sure.
I had a position. I said, let me slightly hedge by selling calls against my position at 480. Market has gone a little further than I thought, but with if there's a pullback today, I might take a chance to just roll that further out on the call side, and then I can just stay into the S&P because I think I find myself, Chris, like I was listening to CNBC this morning, and one of the gentlemen that manages a bunch of money, they all do, but they were pointing out that basically a prudent money manager has to still be a little worried here. Always finding a reason to be worried. That's what you get paid to do if you're managing money, is to worry and, do so, find risk that makes sense to take. But he pointed out that, some reasonable, when you see these new highs and a lot of the good news is kind of behind us, right? Inflation come down story. Okay. That's behind us. A great earnings season. Well, that's just finished up. Yes, you've got NVIDIA, but outside of that,
that's a big I was going to say, but what outside of that, I mean, that NVIDIA is going to be a major play next week. I mean, last year, August, NVIDIA was single-handedly dumped in with Jackson Hole, and it was like one of the most volatile weeks I've traded in a long time, and nothing happened other than like it was like a $15. Let me see if I can go back to the. I remember this because it was a freaking wild week. I also want to show. So I know you and Kenzo talked about gold. I'm loving some silver right now, and I'm loving a little bit of everything.
Are.
So,
Up
dude, silver. I know I told
day.
you. Yeah, silver is. So I'm pulling in some credit spread trades today, which should expire for full profit. They'll be out of the money for full positions, and then my SLV position. Let me go to all accounts right here. Let's go positions. SLV currently sitting up around $29,000. My Philip Morris is up around $38,000. Like, those are my big runners. I'm letting them go. I've got diagonal spreads. I'm going to reload for another 30, 45-day cycles to kind of lower the cost basis. I closed out JD for a diagonal spread. I was in for like a $6 debit, closed it out for like a $13 credit yesterday. That's a China play on retail. I still have some Baidu, some Baba, but let me go back to this story on. Let's go to the SPY August of last year, and let me see if I can kind of relive this for a moment and not have any nightmares. So let's go. This was all around Jackson Hole. This was August of last year, and it doesn't look like much on the daily time frame, but let me find it here. I'm pretty sure this is where we at. August of last year. There's got to be like one weekly candle that stands out, because I just remember a super volatile week, and it just, at the end of the day, like, nothing happened, but man, it was a wild couple of days. Where's my August? Here we go. So I believe it was in here. You're getting the run up somewhere in here. It's like the Jackson Hole move was either this high to low that kind of created the top that started selling us down, or even the fuel that like followed us through. But I mean, it's funny. I look at this and it's like living through that. And just like you can recall, all these crazy events that you've traded through over your career, it doesn't look like much in the chart right now. I'm making like a mountain out of a molehill, when the reality was, if I just traded with less risk, it wouldn't have been a problem. That was the problem. I was just too heavy in a couple of positions and ended up getting assigned, and I had to cut some losses and then, hedge my way out of it. So it was just more work than it needed to be. Different story. But anyway, my point is, earnings on NVIDIA will be a market mover. This year, Nick, earnings on NVIDIA was the reason that we had this gap in the first place. This was all NVIDIA right here, right?
Yep.
So I just think it's going to be the same situation where the market's going to look to NVIDIA as maybe the market can continue to plug away higher. It's going to be a big hit or miss for earnings. And here we are sitting at, at all-time highs or near all-time highs in NVIDIA. If this is a disappointing post or a disappointing earnings announcement for NVIDIA, I could see a gap here. I could see it coming right back down, and I could see a broader market drag lower just in the near term. We have this NVIDIA gap that still may fill, but at the same time, I talk about filling a gap, but it also might break to all-time highs, and NVIDIA can do no wrong. So that's what earnings gives us, and we'll see how excited the market gets. One thing I would say, and I mentioned this week, path of least resistance, man. I mean, it seems like the market doesn't want to go down. Heck, when we actually had all of the scary data right in front of us with the April correction, how quickly did that turn around?
Yeah,
that turned around on earnings. That turned around on Mag 7. So for right now, it's like the market did a pretty good job of saving itself. And now you put in the Fed narrative. Now you put in better inflation readings, and the consumer's cutting back, the labor market's softening. Rates have been changing a little bit. I think the 30-year mortgage has dipped to still above 7, but it's coming down. If you look at the 2 and the 10-year,
yep,
the 2-year yield are still softer a little bit. We're coming back down to that. When we start to see the spike off the April lows and into May, we're right around the same lows on the 2-year, and the 10-year the same thing. Yeah. So there's a lot of cases right now where it's going to be just like you said. The market can remain irrational longer than you can remain solid. So don't fight it. Don't fight it. Don't fight it. Don't fight it. It doesn't help.
In the short term, I mean, it does look great. It's hard to deny that there's a lot of short-term, worries that have been completely shrugged off because, again, data came out and it was good. As you mentioned, we had retail sales numbers that came in, just a little bit light. Let me pull it up on the screen here for us. Retail sales came in 0% compared to 0.4% expected. So you're seeing the consumer start to pull back. You're seeing purchasing managers. That's another one that has been coming in lighter than expected. GDP expectations were 2.5. We got 1.6 in the advanced numbers. So, you're looking at a story here where growth is materially slowing, and inflation. The big question why CPI was so important this week was, okay, you got all that economic data first, but now what you needed inflation to also be coming down. Because if inflation was hot with all that other stuff, the market would have panicked. Because then it's like, okay, now you get the economy slow and 4 months in a row of higher than expected CPI. That would have been really not good. So the market really has a reason in the short term, I think, to have this justified push up. But with a lot of the data behind us, I wouldn't be surprised. You may get a pullback, but even if it does, I think buyers are going to want to step in. I think there's just so many good cases right now. And again, keywords there are right now, because there will be a bearish case that comes back in. There will always be a reason you could point to. If you've got nothing left, you can always point towards the deficit is way too high. And Jerome Powell pointed out that that's a problem, but you can always find something to worry about. The point is, though, the short-term worries that were scaring the market here got shrugged off. And I think that, supports the back to highs and potentially onwards.
Yep. And I will say this, the twist to that of going higher is going to be, I don't think it's going to feel volatile higher. I feel like it's going to be low volume drift, melting up. I mean, that was the one thing that was kind of odd about this rally. It's like, what did we have here? We had gaps, all because of earnings, all because of, it wasn't just like, oh, what an easy week. It was just like this. I mean, look at this is intraday, right? So this shows if you look at my green boxes, that's just because it's a green candle on the weekly time frame. But this is a 5-minute chart that shows me opening bell breakouts, and last week's high was right here. This is last week's high. Okay, this is last week's low. Now, probabilities that I'm trading opening bell breakouts. There's a range for me between 9:30 and 10:30, but we took until Monday, Tuesday, very late in the day to finally drift above that high from last week. And that's why I thought, okay, we barely get above that. And then what happens, Nick? We gap and we have a run Wednesday. Thursday, we actually fade, and Friday is today. So we had one good directional day this week. One.
Yep.
Everything else was it just stayed there. It stayed there, broke out barely on Tuesday, gapped up. All the big movement was in something you can't even trade. It was a freaking gap from 522 and change all the way up towards 527. How do you trade that? That's 50% of the weekly trading range done pre and post market. But if you're long, you got to have a horizon that's not 1 or 2 weeks away. I think for me, if I'm doing long cycles, I'm probably doing like 30, 45 to 60 days out, just to give myself the time and not let that time decay work against me. Because if I'm long options, I don't want to get it wrong directionally. I mean, if we're bullish and the market goes higher, that should be good for our options. But if we're too in the short term, it's going to drain your option trading. You're going to be stuck with intrinsic value. So my point is, I think we go higher. I wouldn't mind seeing a bit of a dip at this point. I would like to see maybe just a brief, and it doesn't have to be much. But even if we briefly test the all-time highs, we just retest this as what could be past highs become support, and then the market goes a little bit higher, and we just keep seeing this melt up. But as you showed in the Edge Finder, June and July and August are all bullish. Yep. And then the next big discussion with the Fed, there's CPI data that week with the Fed. That'll be another big week to wait and see. But it's like we still have 2 more weeks of trading in May. I think this market just keeps melting up through May.
Yeah. So and Chris, I wanted to finish one more thought I had earlier on, positioning for me personally. So I am long the indices. I mentioned kind of my placement in the or my positioning on the account is like half, like a quarter of it is in like XLK technology right now. Okay. And these are trades. Everything in the account is trades. XLK, I've been in for about a month, sold covered calls on it. That's doing pretty well. VOO, so S&P 500, same thing, my spot there. So that's like half the account. I'm like almost 50% the rest of the account, or like 45% is in gold. and then a chunk of it is in TLT. So that's kind of like my overall positioning. The reason I did that is that on the Edge Finder, what I'm liking here, and the reason the indices aren't at the top of this list right now, is because the economic data slowing docks scoring on the Edge Finder for indices. So if economic data is slowing, it does say, not as good there, but it's positive for gold. So right now, the Edge
Sure.
Finder is really screaming across the board. All that economic data that we walked through is pointing towards, okay, there's some cooling in the economy. We don't know how far that's going to go. That could trend for months, and that's
Right.
where, again, I think for me, to remain kind of risk adverse, to remain kind of prudent with it. I don't want to just be all in on stocks because I don't know how far that economic trend continues. If the
Right.
economy, starts to really trend again, they've stayed data dependent. One of the downsides to being data dependent and following the data is you are trailing the data. You're not ahead of the economic data slowdown. So you don't know how far that data slowdown happens. So I want some gold, I want some bonds in the portfolio in case that becomes a bigger trend. So I just wanted to finish out that point. That's why I do have indices, but I also really like the story for gold because, again, you have inflation cooling. That's good for gold and for stocks, but the economy slowing is like a necessary evil for stocks, but it's just a good thing for gold. So I don't know. That's my thought.
Well,
And you got silver, which is even better today.
Well, I mean, and I said silver, I mean, gold's been great, right? Gold's been great. Silver's been, to me, silver's the better technical trade. So I read this morning that Michael Burry, famous gentleman from The Big Short, that he ended up dumping some Alphabet and dumping some Amazon and putting it into gold. So I mean, and I look at that guy as he's not the type of guy that makes emotional decisions. He's basing on the numbers. I know that he has been long, like JD was one of the other reads that I got from him. So JD.com, I've been long. I had a $20 call and a $22 call or $22.50 call. And my actual covered call was at $37.50. So it was pretty much stretching up to that level. I just justified it. Like I could go ahead and roll it out. I think my covered call or my sell call and diagonal spread was out to June. And if I were to roll it, I could get like 20 cents more and keep it at the same strike price, or roll it out further and maybe roll it up $1. But I was pretty much at like 85 to 90% what my max profit was. I went ahead and just protected it, but that was a Burry play. I'm not gonna lie, like it was a straight up Burry play. In addition to, if anyone's in my trading rooms, I've been talking about long China, even though it's this adversarial relationship and China's uninvestable. Look, you trade it with defined risk. It's just like anything else. But I saw the upside potential. So JD looked pretty good from these levels all the way back to 2019. So did Alibaba. So did Baidu. All these other stocks, FXI, KWeb. These stocks have been talking about for a while. But anyway, for Bird to get into gold, I mean, I think you and I could talk every single day about how attractive gold looks in the longer term. I mean, we're in a very interesting environment right now. We're going into, let's say, the next year or the next 4 years. You have to wonder if the deficit, the balance sheet, the QE infinity, all the crazy stuff that central banks have been doing to float and put and manipulate these markets. Gold could be the ultimate winner, right? It could be gold. It could be gold more so than Bitcoin. But look, gold's sitting at these all-time highs, and I thought silver has a chance to catch up, and that's why I've liked silver from the technical side. And this, Nick, we've mentioned before. If you look at gold versus silver, this is an awesome chart to show that silver is crushing it right now compared to gold. And I just think it's because it's time to catch up. Silver has not had the run that gold has had, right? This is just now breaking these 2020 highs. And with this breakout at $30, I mean, I'm trying to stay long until at least my first measured move at 35. I'm trying to get long all the way up to $48 on silver. And so my trade is not XL, SLV.
Yep.
And I've got it measured up to 32.77 and up again to 44. Now, I am playing it strictly through options, which will allow me to end up making more profit if I hit my targets. But ultimately, I just want to have shares of SLV. Now, I'll ask you this. Would you rather have shares of a $27 stock that has, let's say, upside potential of, measured, by the way, 60%? Okay. Would you rather have that, or would you rather look at GLD And let's plot 60% on GLD and just think about it for a second. Let's go from current price of 222 on GLD and go up 60%. I mean, I got to compress the chart like crazy.
Yeah, right.
Can we go up 60%? If we do, we're talking about GLD right now from 222 to 357. Now, as a percentage move, I don't even know what that spot price is on XAU. But to me, it's like, I don't see it. I can't comprehend it right now because that is speculation that I don't have measured. That's speculation that's the bubble. That's a gold bubble.
That'd be 3,900 on the spot price of gold.
Wow. It's crazy, right? And Chris, so silver to me is more calculated. That's all.
That's the thing is if we've talked about this a lot. If the metals market is really going to make a rip, a great sign of it actually going to do it is being led the charge by silver. Gold usually starts it, but the real question is if it's going to continue, if it's going to follow through. You want to see silver making big moves. I kind of have some exposure to this by proxy. I have a TAN position, which is a solar. One of the big reasons I listen to a lot of silver channels that talk, day in, day out about metals. Okay. They talk constantly about the solar, kind of world and the massive growth in solar over the longer term that has, year over year, there's more and more growth where solar's been killed because it's a borrowing cost, destructed area. Because everybody, if you want to buy solar panels, it's a borrowing cost focused buy, and borrowing costs have gone up. If borrowing costs come down and solar, continues to grow at the rate that it's grown for years now, that's a huge real scenario for silver. But that's not the only reason. It's just industrial metal in general, and it's just severely, in my opinion, oversold. It has not. It's way more valuable than where it currently is priced. And I could get on off a whole tangent when it comes to gold and silver.
Yeah.
At all-time highs for gold, I think it's cheap because if you look at its historical hold of value, it is very well underpriced. A home purchased in 1920s, 1930s, whatever, the amount of gold that it would take to buy that house then, that same amount of gold should be able to buy you a comparable house nowadays, and it doesn't. Throughout history, gold usually holds its value. So I think it's very longer term undervalued, and same thing with silver even more so. Silver's gotten absolutely destroyed over the last 20 years or whatever, thanks to inflation, and I think that there are some corrections that could happen there if stocks on a longer term basis at some point fall out of favor a little bit. So I don't know, we'll see. Chris, I'm gonna leave you to take over the show here for a little bit. Before I step out, let me just say to everybody who's listening, guys, Chris Pulver has been coming on the show for a while now. He comes on, takes over the show, does a good mix of fundamentals, technicals, options, everything under the sun. He does Forex. He does it all. Stick around with Chris. He's going to take over for a second. And please do me a favor. Make sure to go subscribe to Chris Pulver on his own YouTube channel. If you're watching on Twitter, it's at Real Chris Pulver. You can find him there. And make sure to show him some love. So, Chris, enjoy it. You got the show. And happy Friday, man. Have a great weekend.
Thanks, Nick. Thanks a lot. All right, cool. All right, everybody. You can go ahead and post some charts if you'd like me to take a look. I just finished my my live session at 9 o'clock and jumped in to join Nick and the team. And I wish, I feel like Nick and I missed an opportunity to talk about GameStop. Maybe he had mentioned it earlier in the show, but it looks like reality. In a lot faster fashion, right? So again, I'm hoping that people weren't left holding the bag because you have this rip and it made all these headlines and Roaring Kitty looks like a hero. And here I am celebrating the fact that I got a PlayStation 5 and I'm jumping into Helldivers 2 and I love the game. And here we are down 46%. Actually, I'm sorry, up 46%, but we gave it all back. We gave it nearly all back. 43.5% to the downside after a crazy day. Also, I think this week, I'm not sure how many times it was halted, but GameStop was halted multiple times this week because of the big chunks and movements. So anyway, Tim's asking for SPX monthly. So this week we have monthly expirations and we have weekly expirations and we have zero DTE. So there's a trick question out there. If people want to know, like, when was zero DTE invented? Well, the answer of true zero DTE on the indexes where you had day-to-day expirations, that was in 2022 when zero DTE on the indexes came into play. But if you truly think about a 0 DTE, if you had a monthly expiration and it's sitting on the day of expiration, you actually had 0 DTE back in 1973. So it's just evolved into now offering more liquidity, more expirations. The options market has blown up over the last 10 years. It's just become more and more popular, more and more volume coming in every single year. And why? Because it's a way for traders to add leverage to a stock portfolio. Trading options is awesome. We could talk about this all day. I mean, most of my portfolio right here is very little ownership, almost all options. I will give you a rundown real quick in my portfolio. I will take the list. I see the SPX, I see Bitcoin, I see the Dow. IBKR, you want to trade some interactive brokers? Okay, QQQ, yes. Everybody's holding the bag. Red Webull chats, it's sad. I mean, it is sad, and it's just like, those are clearly not traders, okay? Those are YOLOers. Okay, those aren't traders. That's the lottery ticket. And look, I have friends that, you know, they jumped into Bitcoin mining, they got burned. I had friends that jumped into Shiba Inu and Doge, they got burned. I had my nephew took a $1,000 junior account, bought GameStop at $17 a share, and was a part of the run when it went up over $400. I was telling him when we saw pre-market gaps, this was back in 2021, when we saw pre-market gaps at $50 to $70 to $80, I mean, a $17 stock that's trading for $250 to $300, I'm like, just take the profit, dude. Like, he took $1,000 and turned it into almost $6,000. What did he do? Didn't take the profit. He was drinking the Kool-Aid. He was like, no, this is a fight against the man. I'm like, bro, you're 18 years old. What do you know? I'm like, just take the profit. He didn't, and it's back to where he started. So same thing. It's like he owns it at 17 a share, and GameStop went up to 50, 60 bucks. Did he do anything with it? Probably not. I don't know. So it is sad, but that's not a trader. That's not an investor. I don't know what you want to call that outside of it's gambling. And now you have, you know, this, you have a personality, an influencer. You know, again, no offense to Roaring Kitty, like Keith Gill knows the stuff. He worked in the industry, but did it help traders this week? If they took profit, sure. If they didn't, I mean, who knows? Because, you know, people have been buying GameStop when it was at $100 and it was at $150. And so they just get excited and then are instantly disappointed 2 days later, you know? So anyway, all right. I was just going to go through the portfolio really quickly and show, you know, what is options, what is ownership. So Apple, I have some ownership, mostly options. Amazon, I have zero ownership, all options, and I'm up a couple $1,000 there. Boeing, that's all credit spreads. Baba, that's all options. BCS, that's options. Baidu's options. BITO's options and ownership. Bros is all options. That's a Dutch Brothers. That's a coffee company. This is an aluminum play. That's all options. Chewy, I do have some ownership. Clorox, that is, oh, son of a gun. I need to watch this today. Let me see what I can get out. So Clorox, I need to check this. So here, let me check and see what it's trading for today. Ah, fudge. I need to try. I'm going to keep an eye on this one. We're at 135.84. The expected move should not threaten 135 today. I'm gonna watch this one towards closing bell. Here's why. Okay, I have a 135 by 130. I do not want shares of Clorox. I want to close this out for full profit. Each credit spread that I took is about 53 to 54 cents on 10 contracts. So if it stays above 135 today and settles, then I will make 540 bucks on Clorox. I just need to watch this to make sure it stays above 135 today. So that's one I need to be mindful of. Cisco's all options. CVS, I took some small ownership of it. I saw the big gap in earnings. We're down to lows we haven't seen since like 2019 and 2016. I'm taking a little bit of a repair trade for 100 shares, try to get $3-4 a share on that. The DIA, it's mostly options. All the indexes are options, but I have a couple of ratio spreads on the major ETFs. What else? IBIT, that's ownership and options. IWM is all options. JetBlue is ownership and options. JD, options. Anyway, I can go on. I mean, I don't want to bore you with this, but I would say about 85 to 90% of my entire portfolio is all options and very little ownership. And the reason that I do that is it allows me to see the type of gains that I want to see without tying up all of my capital, right? So I have plenty of stock buying power. I have plenty of option buying power. So in the event that we have really good asymmetry and really good opportunities, I still have plenty of cash at the ready to deploy, right? So options allows me to use less cash, still get the juice, still get the alpha, and still have plenty of cash and buying power at the ready if needed, right? So that is that. Let's start taking some requests. Let's go SPX, sure. So as I mentioned before on SPX, we're creeping up a little bit higher. Here's the SPY on the day. I don't know if we're going to come back to all-time highs. This is the SPY. Let me see if we can get this back up here. 531. I'll just put ATH. See if we get back to all-time highs on a Friday. The SPX has peeled back a little bit. I have a credit spread that's sitting in at 53.30 right now. I'm trying to do a bear call spread to sell off those highs. I think that's pretty safe. I'm trying to get filled for $1. I don't know if I'm going to get it filled. I had an awesome butterfly in the SPX yesterday I was pretty happy with. But let's see what happens today. So if we go low to high, average daily move is 41 points. The low of the day here, let's say we go up to the average move. 41 points puts me right around that 5,300 mark. Ooh, that's going to be close. It's going to be close. But we'd have to get to all-time highs today, and that's the highest gamble level that I see on the SPX. So let's go back to the bigger time frame. Again, I mentioned this before. Technically, I'm a little concerned that the market, yes, it can go higher, but I think at least a little bit of a pullback is needed, all right? I see overbought conditions with hidden bearish divergence, and I see disagreement between price and momentum. So this high, yes, I understand it can stretch a little bit higher, but the last time we had this big run, this was a ridiculous run from October to March. It was 16 of 20 weeks or 17 of 20 weeks that were up. I don't think we repeat that necessarily, but if we do go higher, I don't see it making big blowout candles. If we go higher, something tells me it's going to be these little tiny carving out, like just carving out all-time highs if it's going to drift a little bit higher. Like I said, I'm a little sketched moving forward. I'm a little cautious moving forward because we're at all-time highs and there's still all this, background noise and all this concern with what the market, can do and should do and what's reality. Look, we know this from 2020 and this from a lot of the times in the market cycles. The stock market does not reflect reality. The stock market does not reflect the real economy. Now, what's happening is right now it's using all of this optimism on earnings, on a softer Fed, on more dovishness, on rate cuts, on these things that are all anticipated, not quite happening yet, right? The Fed is not at 2% inflation. 3.4 year over year is a long ways away from 2% inflation, okay? So that reality will still bite at some point. But right now, earnings has been solid. I swear next week, it might seem like a sleeper, but next week with NVIDIA earnings, it's going to be a big deal, right? I do think NVIDIA, if we push higher, I could see NVIDIA putting a softer high into the market and it gets faded from there. Or I can see NVIDIA, if we miss, be one of the major reasons and catalysts for the market to actually have a bit of a decline, right? So that's just my technical outlook on the SPX. I mean, I'm looking at overbought conditions. I'm staring them right in the face on weekly timeframes. And technically that just gives me a little bit of concern, right? Doesn't mean that I'm bearish, right? It just means it's a little bit of concern. So I would like to see a dip or a pullback first. If we have a pullback towards recent all-time highs, or we pull back, let's say that we cut this move in half. Let's say we cut this move in half and have like a 50% pullback, and then we start to see that we're back up to all-time highs, fine. But give me some structure outside of just higher highs, higher highs, higher highs, gap higher, gap higher. That's tough to trade sometimes, But what I've been noticing on my, day-to-day software is this week, it's funny that I'm showing you this right now on a live session Friday, but this week, all of this has been gone. All I've been looking at this week is I've been looking at gamma levels to the upside, no sellers to the downside. It has been completely absent, right? And look at today. Today's put and call ratio is 52% puts and 29% calls. So sentiment-wise, the puts are trying to take control a little bit, but there are at least some levels to the downside to show, okay, we might pull back a little bit. But this whole week, I swear, it's looked like this. Let me just, I don't know what that color is. I'll just make it black so it blends in. It essentially looked like this all week, where all I saw was up, higher, 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 drift, 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 melt up, gap. That's all I saw all week. So if that continues, that's probably what I'm seeing is an absence of sellers, more of the drift, let the market melt up. Look, if you're long, you're loving this. I'm staring at all-time highs in the portfolio. I do have a bullish bias on a lot of my positions, but I'm also diversified. I mean, Nick had mentioned he's in bonds, he's in gold, he's in technologies, playing some sectors. I have quite a bit of stocks in here, but they're all over the place. I have retail, I have metals, I have aluminum, I have silver, I have gold, I have Bitcoin, I have tech, I have AI, I have, Mag 7, I've got all sorts of stuff. But I also have treasuries. I have TLT, right? I've got China exposure, so I'm also non-US. There's a lot of ways to dice up the market and diversify. Okay. All right. Let me go back to see some other comments. So that help on the SPX. So I'm fine with the market melting up. I think it's going to continue to happen. I personally would like to see a little bit of a dip or just a check, right? I mean, we've rallied 7.5% off of what seemed like, oh my gosh, how ugly does this get? We rallied 7. That is 7.38% in the last couple of weeks. That's a pretty good recovery to actually poke the highs. Now, one of the trickier patterns in the market, okay? One of the trickier patterns in the market is this, a broadening pattern, okay? I'm not saying this is going to happen, but if we start to see let's say that next week, for example, we get this big evening star type formation. If that's the case and we start to drop lower, it's not a bad thing because I'd be looking to line up some buy trades down here at the base of this broadening pattern. But that would be what would make this current environment a little tricky, right? A little tricky. I don't think that's the play. I think we're going to continue to carve out higher lows and higher highs, and it's going to feel like a melt up, and we'll deal with that. All right. What other stocks were asked? I saw that the Dow, so the US 30 was asked. Okay, we're sitting here, poking those all-time highs. We touched 40,000 for the first time. By the way, is anyone familiar with the rule of 72? It took 7 years for the Dow to double. Okay, 7 years. So if you take 7 years, 72 divided by 7, so you take your rule of 72, you can take a couple of things is how long does it take my account to double based on X amount of return? If I get, 5% a year, okay, if I make 5% a year, how long does it take to double? So it'd take me 14 years to double my account. Or you can take the 72 divided by the number of years it takes to double because the Dow just doubled. 72 by 7, it was an average of 10.28% per year annualized for the last 7 years. That's pretty good on the Dow. That's pretty good for the boring blue chips, right? The Dow has stayed right in there and outperformed or performed just as well as, the S&P and maybe off the NASDAQ a little bit. NASDAQ probably outperformed, but obviously with NASDAQ, you get a lot more volatility to the downside. So here we are again, sitting at all-time highs. I'd like to see this rally get checked just a little bit, but this to me has room to run. And this is probably the quote safer index to be in. I mean, if you take these 30 companies that are price weighted, not market cap weighted, this is a little bit more of a reflection of it's more of a balanced portfolio. Nobody's it's not oversized because it's all price weighted. That's different in the Dow versus the S&P and the Qs, right? But we're sitting at all-time highs. Where can we go? Well, once momentum gets up here, let me check. We're just at the all-time highs. Momentum can drift up here. Let's just use a simple fib, for example. You see this on my chart. Because we had a 30% pullback, there's a big probability that pullback at 30% will hit the highs. Mission accomplished. We just did that. Now, if it's going to stretch a little bit higher, we could go up towards this 1.8 or 1.27. So if we're going to continue to melt up higher, I could see the Dow, now that we've broken that milestone of 40,000, I could see us at 41. I could see us at 42. All right. Does that mean that I need to be bearish on this for a big correction? Not yet. Right? Not yet. There's got to be some really crazy stuff happening for that to be, where we end up going directionally. But right now, it's path of least resistance and don't fight it. Okay. What's Interactive Brokers? Interactive Brokers is IBKR. So we're trading here at all-time highs. We have overbought conditions with divergence. I was looking at this a couple weeks ago, and I thought about taking a short position on IBKR, that's Interactive Brokers. I mean, I don't know if I need to. I could just put something out of the money. We have earnings on this. So there is a dividend declaration on May 31st. We have news on this, unveils crypto trading for UK clients. Okay, there's some good news happening here. Next earnings report isn't until July. I could see IBKR going a little bit slower. So even if I went, let me see what their rank is right now. If I go IBKR right here, their IV is at 11.8. That's super low. As just an example, if I just did something, okay, I'll go out 60 days. When's their earnings? I don't want to go out past earnings if I don't have to. June 24th. Can I do something prior to June 24th? Yes, I can do it. I can do a June 21st. That's 35 days out. I could look at, there's good and bad here, right? I can go out pre-earnings. I can go out to a high probability trade. I could do like a 21 delta. I could do a bear call spread. I don't like this risk reward though. I'm collecting 50 cents on a $5 spread. That's pretty crappy. But that's because the IV rank is so light. I think that the expected move is, about $5 for the next 30 days or so. If we're trading at 122.64 and I put in a bear call spread 135, I mean, I can tighten this up and make more money. Right now I make $1.42, but I'm flirting with that potential sell side. So I would go slightly out of the money, take a 21 delta, do a 130 by 135. Is it a probability? Sure, it's a 75% probability profit that this is not threatened. I think because this is pre-earnings, I think it's going to be okay. But do I love this trade? No. I would much rather have a higher IV rank, higher implied volatility, collect more premium on this. If I'm going to take the risk to be, short a stock, which I'm not with defined risk, but I just think if I collected, $1.25 or $1.50, I'd like to trade a little bit more. So that's about the only way I trade it right now, outside of if we have any dips. I mean, heck, it'd be nice to see a dip, right? It's like I have a hard time getting long at all-time highs. URA, that's another stock that I'm in. It's at a chart I'm going off at 32 and change. Let me check on that one really quickly. So it's interesting. Nick and I talked about gold. We talked about silver. Uranium is another one. I talked about copper. Copper's making a big run. Copper's up like 23% in the last couple of months. This breakout that I had on my copper chart, this was back in March. And look at this. We're staring at overbought conditions. We're staring at all these technical indicators that would probably cap this move on copper. But I traded some copper futures and some credit spreads. Not nearly the type of profit I'd like to make for a rip like this. But yeah, uranium is another one where if we're making this move into nuclear power and back into, I'm not going to say clean energy necessarily, but alternative energy, uranium is a play because the supply and demand side of things, uranium is crazy amounts of shortages. As not just the US is looking for nuclear power, but Europe is a big one. And if they start leaning that way, then lithium is for EVs, but uranium is going to be for nuclear energy. So if we're just getting above these highs, I've got some trades in. I got to check this one actually. I think I have a expiration today on URA. I think it is a reverse jade lizard. Here's URA sitting up around $7,000 on this right now. I have a 22. Let me check some of these stocks or these positions. So I have a call that against that I'm selling the 35. I paid $9.59 on that debit, and I just checked this yesterday. I think it's trading for like $13 right now, something like that. Yep, trading for $13.53. So I'm up about just shy of $4 profit on this, which I'm going to try to let it run a little bit more. I mean, price is trading at $32.68. My sell call is at $35. That gives me another couple dollars of upside, and that's also out to what's the expiration? Oh, so I'm going to add to my diagonal after today. So I'll go out and probably throw in another cycle on this. If I go out to, June 21st, that's 35 days out. I could add another $35 call or sell against my diagonal, get another 65 cents, lower my cost basis. If I want to go up in price, I could obviously do like a lighter delta, like the 15, 16 delta. Still collect 25 cents on a 37, give me another $2 of upside. I think I'm going to do that. I'll collect the full premium on that sell call, roll it, or not roll it out, but just deploy once again to a maybe 36 or 37, lower the cost basis on my debit spread, but also let uranium run a little bit more. So anyway, I got this distracted there. It's like, a dog or squirrel where I just, I see a chart alarm. I got to run and take a look at it. Okay. Let's see. Giancarlo, wonder if you had any tips on growing a small funded account. Not really into scalping, but minimum contract positions. So what are you trading there, Giancarlo? What do you trade? What's your go-to instrument? I mean, small accounts, and I just talked about this this week in my trading room. I mean, I have helped. I've been fortunate to be in a position where I've taught financial education. I do sell courses. I do teach a lot. I do my live sessions. Not that long ago, I mean, to me, it seems like, 15, 20 years is a long time to be in the markets, but I was just a retail trader, just like you. I still am a retail trader. Okay. So small accounts to large accounts, there's still ways to get it done. The big thing with a small account is typically small accounts force traders to take a little bit more risk up front. But what you're looking at is you're trying to take trades on a small account if you can land trades with asymmetry, meaning if my reward is bigger than my risk, take those trades as much as you can. As an example, I took a trade yesterday on the SPX. I did a butterfly in the SPX that cost me 30 cents. So it cost me $30. And this is just a small account. So take a $1,000, $2,000 account. You can risk $30. Okay. But that trade paid $190 of profit by the end of the day. There's not a lot of trades out there that you can get 5, 6, 7, 8 times your risk in a single day. Now, do I take those trades every single day? No. But when they line up and I can look at a big upside potential, look, I can lose 3, 4, 5 of those trades, win one of those trades, and make all my money back and still be net positive. So to me, a small account, the secret is define risk, never taking huge risks because you'll blow up your account and never stick around very long. But to make sure that if you are trading, you're trying to go for reward to risk that's always favorable. That's a really simple way to do it, because when you're right, you're getting ahead way faster. And when you're wrong, you just take the little paper cuts and move on and keep trading. But it is certainly, keep the trades small, keep grinding. It's going to be a process. But I like the fact that if you are taking trades with better upside and better risk, better reward potential, then it works pretty well. Okay. All right. Microsoft. Sure. We'll take a look at Microsoft here. And if I miss any, I'm sorry. I missed some shout outs or missed some requests, but you can type it in the chat. I'll check it right here. Microsoft sitting near all-time highs. Again, I see some range bound trading on some of the Mag 7. Apple has come off the lows pretty nicely. Apple's trading at 189. I do own shares of Apple, but I have it covered out to 170. I think I'm fine at 170. I mean, I have it covered at 170, but I've got my cost basis all the way down to 154. So I'm good just like sticking around, having some ownership. The rest is credit spreads. The rest is long options. And, if Apple gets back to the highs at 200, awesome. Do I think Apple's going to go and break out to 250 to 300? I don't think so. I could see Apple doing, this, right, where we maybe have a range trade. If Apple does break, okay, so we have some consolidation here, right? If Apple does break the highs and starts going higher, the nice thing is everybody can be paid if Apple's at all-time highs and Microsoft's at all-time highs and the SPY's at all-time highs and the Q's at all-time highs. It's just a matter of, are you participating, right? And if that is the case, if we see broad market strength, and I mentioned this on Monday during the session, if we see broad market strength, you do not want to stand in front of that moving train. That is a very powerful force in the market that when it aligns and everything's up, that's a good thing. So a way to feel that out is, here's a simple screener. Okay, I'm just going to go to the home page. We have 69.5% of stocks above their 50 moving average. We have 70.6% of stocks above their 200 moving average. That right now, everybody, is showing broad market strength. Okay, that is a powerful force. That is part of the reason that October to March was so aggressive. That is part of the reason that the recovery in 2022 into 2023 was so aggressive. We had a couple phases of broad market strength. And if we're getting that now after an April decline, it'd be awesome to see that kind of every stock is enjoying this run. Everything floats to the top. The melt up is the real deal. And there's a lot of money to be made, right? And I know at the same time, it's easy to be like, I can't believe I just want to short it. It doesn't make any sense. It's not the right market to do that, right? The broad market is going to be a strong, resilient. Bad news is good news. No news is good news. Everything is an opportunity to buy and see how these runs really happen. And at some point there will be a trigger, right? At some point there will be a breaking point. At some point there'll be a top. At some point there'll be a correction. But like we said all year, I think a lot of the runway this year is, as long as the market can get through and get out of its way and the Fed doesn't fudge anything up and it doesn't get overly reactive and sensitive, I think the market's going to continue to price in some good stuff, be forward thinking. And then maybe the reality check is, when the Fed cuts rates, maybe that's more of our top. When the market gets through this year to start the rate cut cycle, or maybe when the rate cut cycle ends, maybe that's our top. So we do realistically have runway through the end of this year to see the market be rational. And a lot of that is because we're also in an election year. Historically, those are pretty bullish and one-sided. We don't see a lot of drama during an election year. Right now, the geopolitical stuff, it seems to be contained, right? I'm not saying it's isolated, but it seems to be contained, like U.S., China. Okay, fine. China's lifting animal spirits, coming back out. Animal spirits in the U.S. being lifted, broad market rally in the U.S. happening, resilient economy, all this other stuff. But this is why I don't want to fight it. If overall the portfolio is up and it's broad market based, don't fight it. Okay. All right. Couple more, and then I'll let you go. QQQ, same thing as before, right? All these other indexes are showing a lot of similarities. I do see overbought conditions with some technical divergence. So that means price momentum disagreeing. I would like to see a little bit of a pause, even a dip. If we have a little bit of a dip, I'm looking to buy that dip. We could just see this as a bull flag though, right? This could rally up here, pause a little bit, and then we start to rip higher. So I still think that we're breaching highs. The market's excited. The broad market is catching up again. That's what this was, by the way. This was a broad market rally. Okay. This was a broad market rally. This was a broad market rally. It doesn't happen all the time, but this was, this was AI and Mag 7. Okay. This was everything. So this, I'll put all. This was all in this window. And then this was all in this window. So we have phases where it's not everything. Right. Anyway, Qs, I'd like to see a little bit of dip or pullback. I'd like to see a pause if possible. But I think we're just going to continue to melt up a little bit higher. DIA, US 30, same thing. TSM, that's Taiwan Semiconductors. A lot of these semiconductors look very similar to NVIDIA, right? If we go to, let's just do it. Let's do a quick glance at it. Let's go TSM. We're sitting near all-time highs. There's a dividend declaration in June. Earnings have already been in, hit top and bottom in a good way. We've got earnings all the way out to July now. But I'd say the big one for semiconductors will be NVIDIA. Okay. NVIDIA here. AMD is trading up to 167. Oh my gosh. Check this out. 165 and 160. The surprise of the week, everybody. For me, at least. AMD. Check this out. AMD. Did I close it yesterday? You idiot. I closed it for profit yesterday. It was, oh, you freaking moron. I closed it for a small loss. Nah, fudge. Well, that's what I needed. Dang it. Fudge. Oh, well. I took a small loss in AMD, but I was also upside down the entire time. I had a 165 by 160, and this thing was down to 142. So the fact that it ripped back the way that it is, I took like a $1.50 loss. It's not that big of a deal, but if I could swear, I'd swear. Shikaka. Anyway, it got above 165. So that would have put my credit spread into profit today. And that would have been, whatever, 50 cents a contract or something like that. So anyway, but AMD, is it back to highs? No, it's not even close. So we're not all equal, right? TSM is near all-time highs. AMD is well off those levels. If you look at SMCI, that's another one that's in the space. So it is an interesting mix of like where these semiconductors are at. What's the other one? I think Micron is one. Micron is back to the all-time high. So these are all kind of the same space, like semiconductors. So TSM, MU, NVDA sitting near these highs. Next week will be a big week. It will be a big week. NVIDIA is going to kind of be the one to control them all. And we'll see what earnings gives us next week. I will probably trade earnings on NVIDIA. And realistically, I'm not going to trade it with a high debit. I'll probably do like an in-the-money credit spread, take my chances there, see if I can turn, $7 or $8 of credit into $1 or $2 net profit. Just take a safe play on it. There's no reason to get caught up in all the craziness and spend a bunch of money on a debit that may or may not be a big mover. It should be a big mover. If I check and this will be the last thing I have time for, and then I'll switch over to my equities on the main trading room. NVIDIA, if I go to my numbers here, you've seen me do this with Frank on the show. NVIDIA averages around, you can see here that once NVIDIA started making it on the radar in 2023, the earnings volatility has increased in a big way. Let's see, expected volatility, the EVR is 3.7. That's fairly high. I did an entire filter trying to get three or better. So we're getting double digits. It says the average is 13.23. I would probably say on the safe side, I'm going to calculate a $13 move. Okay. Or 13% move. And what's 13% on a stock that is trading at $938.10? It's going to be a big mover. That's $100 and some, right? So if we did a 13% move at a $938 stock, you're looking at about a $122 move. All right. So let's see what that looks like. And again, I'll price this more out in detail next week. But let's go 13%. And how many times over the last 10 plus earnings have we hit at least 13%? Let's find out. So if I go out, and I only do these trades out to 8 days, I don't go past that because usually I'm not buying any premium past that. This one checks the box. Day one, we're 16%. This one does not. This one does not. This one does. This one does not. Actually, I said 13%. That one does get there. That one does get there. My fault. This one does not. This is my least favorite. You can see 8 days out is at 19% to the downside. I hate the fact that I'd have to wait that long to get the move. This one, same thing, 8 days later. Fudge. That's tricky. That's really tricky. This one does not. And this one does not. So I'm just going to say this. I don't like the fact that it took 8 days to make those movers. So I'm going to cross those off. That only gives me 3 out of 10. I don't love the probabilities of NVIDIA. Now, we know that there's going to be a ton of IB around that, and it will be a mover. But like I said, the best way for me to trade that would be, okay, we have NVIDIA next week. So if I went out to a trade, the 24th is next week. If I want to do a one-day management or I do a two-day management, let's just find this out. So we're expecting to see an $89 move. I calculated based on the 13% move, we're probably going to see closer to 120, 122, which means I could probably set up a bear call spread. If I do a bear call spread, I go down $100. We're trading at 940. I'll go to 840. Let me see what this looks like. If I did an 840 bear call spread, I can get $395 out of a bear call spread and only risk $1.05. That's totally fine. And then on the $100 to the upside, if I went to 930 or 940 to 1040, I'll do a bull put spread. So I could take $7.50 or $8 and change on this credit spread. And if we see price move to what I calculate out to be roughly a $100 move, then I should be able to turn an $8 credit and probably take profit. Let's say I close this for like a $7 debit or $6 debit, make a couple bucks on this. And that to me is a safe way to trade it. As opposed to if I did a long strangle or a long straddle, you're going to see how much that's going to cost. If I did a long strangle, you're going to pay $89, which is over, it's almost $9,000 in risk just to say, I hope it goes $89. It's supposed to go $121. So you can still see that the probability of profit's pretty high. Even if it went $100, you should be enough to grab maybe, $5 or $10 of profit. But that is a massive risk because worst case scenario is maybe it only goes $50. And now you don't have enough to cover the cost of your trade. So anyway, we'll talk about that more next week. Okay. All right. That's that. All right, everybody. I'm going to let you go for today. Happy Friday. Nice to be with you. For A1 Trading, thanks a lot for letting me join in today. And Equities on Demand students, I'll see you in a couple minutes. One last thing, I know Nick and the team posted in my channel. My YouTube channel is youtube.com/Chris Pulver. I also have a Discord. It's just a free group chat that everyone's a part of. Everyone can join. It's a lot of fun just to have all my content in one place. So if it helps, awesome. Happy trading, lots of profits. All right, take care, everybody. Have a great weekend. See you soon. Thanks, Nick and team. Bye.
Thanks again for watching today's show. Our goal at A1 Trading is to share free value to you, our audience, through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more, lest ye walk the plank. Join our crew as we head out to go long on gold. See you next time.